Let me say this up front. This isn't about red vs blue. This is about money, your money, and what actually happens to housing when politics, power, and headlines collide. Because when people hear Trump and a housing market in the same sentence, emotions go crazy. Understanding does. So let's slow this down and talk like real people. Here's what most people miss. The housing market doesn't crash because of tweets or speeches. It moves because of policy, pressure, and incentives. And when Trump talks tough on interest rates, the Fed, immigration, taxes, or government spending, that's not noise. That's a signal. Not a guarantee, a signal. And the people who get hurt are usually the ones reacting emotionally instead of strategically. I've watched this cycle before. When uncertainty hits, regular buyers freeze. They wait, they panic scroll headlines. They tell themselves, I'll buy when things feel safer. Meanwhile, investors do the opposite. They ask, who's being forced to sell? Where is fear creating discounts? What still works, even if prices stall? That gap between fear and preparation is where wealth quietly shifts. Let's talk reality. If rates stay high longer, affordability stays broken. First-time buyers get squeezed. Sellers who need to sell lose leverage. That doesn't mean prices instantly crash. It means pressure builds unevenly. Some markets crack. Others just go sideways. Some deals quietly become very good, if you're ready. The housing market doesn't move as one big block. It fractures. Here's the mistake most people make right now. They're waiting for a headline that says, and now it's safe. That headline never comes. By the time things feel safe, prices have already adjusted and opportunity is gone. That's how it always works. Let me be clear. This is not a go buy anything moment. This is a get disciplined moment. Cash matters more now. Reserves matter more now. Bad deals get punished. You stretch, speculate, or assume appreciation will save you. This market will humble you. But if you're patient, conservative, and realistic, you don't need a crash. You just need stress. And here's the part nobody likes hearing. Politics don't destroy markets. Overconfidence? Overconfidence does. The people who get hurt aren't the ones who bought homes to live in responsibly. It's the ones who over-leveraged, underestimated rates, counted on bailouts, assumed the market owed them growth. Housing always corrects arrogance. Always. So, what do you actually do right now? You stop guessing headlines and start controlling what you can. You keep your finances boring. Don't rush because of fear. Don't freeze because of noise. Run numbers like appreciation doesn't exist. Assume higher for longer and plan accordingly. That mindset alone puts you ahead of most people. Trump didn't declare war on housing, but uncertainty, pressure, harder rules, that is a battlefield. And like any battlefield, the winners aren't the loudest. They're the most prepared. Stay calm. Stay liquid. Stay calm. Stay liquid. Stay patient. That's how you build wealth when everyone else is arguing. Headlines are not written to help you build wealth. They're written to grab attention, stir emotion, and keep you scrolling. Fear, outrage, urgency. That's what gets clicks. And when politics collide with housing, fear spreads fast. But here's the important part. Fear doesn't move housing markets. Policy does. Most people confuse the two. They hear a loud headline and assume it equals immediate damage. In reality, the housing market responds slowly and unevenly to changes in interest rates, lending standards, taxes, immigration, and government spending. Those are boring topics, which is why they're rarely the focus of viral content. But they're the things that actually matter. When Trump talks aggressively about interest rates, the Federal Reserve spending, or economic pressure, it creates uncertainty, not clarity. Uncertainty makes regular buyers hesitate. They pause purchases. They delay decisions. They tell themselves they'll wait until things have settled down. That hesitation has consequences. Housing is one of the few markets where confidence itself affects prices. When buyers disappear, sellers lose leverage. Not immediately, not everywhere, but gradually and in very specific situations. This is where opportunity starts to form. Fear freezes people. Policy reshapes incentives. Most buyers are emotional. They buy when they feel safe. They stop when they feel scared. Headlines amplify that emotional cycle. When news turns negative, demand softens even if fundamentals haven't fully changed yet. Investors understand this gap. They don't ask, is the news bad? They ask, who does this pressure? Higher rates pressure sellers who bought recently with low equity, need to move for work or family, over-leveraged assuming rates, would can't carry a property long-term. These sellers don't show up in headlines. They show up in listings, price cuts, and quiet negotiations. Create stress. Stress creates opportunity. The housing market doesn't crash. It cracks. Another mistake people make is thinking housing moves all at once. It doesn't. There's no single switch that flips prices everywhere. Instead, markets fracture. Some areas drop faster, sit longer, require bigger concessions. Others hold steady, barely move, stay competitive. Headlines talk in absolutes. Housing moves in specifics. If you're watching national news instead of local conditions, you're missing where opportunity actually exists. The 1% knows this. They don't wait for confirmation. They watch pressure points. Why waiting for a certainty costs money? People love certainty. It feels safe. But certainty in housing only arrives after prices adjust. By the time headlines turn positive, rates are already priced in. Demand has returned. Sellers regain leverage. That's not when deals are made. That's when competition comes back. The opportunity window exists when fear is high, but fundamentals haven't fully broken yet. That window doesn't last long, and it's uncomfortable. The people who win aren't brave. They're prepared. Preparation beats prediction. The biggest myth in investing is that you need to predict the future. You don't. You need to be positioned to respond. The 1% doesn't guess what Trump, the Fed, or the market will do next. They build flexibility. A cash reserves, conservative numbers, patience, strong financing. That preparation lets them move when others can't. Most people don't miss opportunities because they were wrong. They miss them because they weren't ready. Headlines make people emotional. Emotions make people predictable. When fear rises, people behave in patterns. Buyers hesitate, sellers negotiate, media amplifies. Extremes, investors don't fight these patterns. They use them and they stay calm while others overreact. They look for deals created by stress, not hype. They don't need the market to crash. They need it to strain. The quiet transfer of leverage. Here's what rarely gets talked about. When fear enters the market, leverage shifts. Not from rich to poor. From emotional to prepared. That shift doesn't make noise. It doesn't trend, but it's real. Buyers with cash and discipline gain power. Sellers with urgency lose it. That's how wealth quietly moves during uncertain times. Final reality check. Headlines are loud. Policy is slow. If you let headlines control your decisions, you'll always be late. If you understand how policy applies pressure, you'll see opportunity before it becomes obvious. You don't need to cheer for or against anyone politically. You need to understand incentives. Fear creates hesitation. Policy creates pressure. Preparation creates opportunity. And in housing, opportunity rarely announces itself. One of the biggest mistakes people make when they hear high interest rates is assuming the housing market moves like a light switch. On, off, boom, crash. That's not how housing works. Housing doesn't die overnight. It breaks unevenly. It fractures, and understanding that difference is the key to not missing opportunity or walking into the wrong deal. The myth of the national housing market: there is no single housing market. There are thousands of local markets, each reacting differently to the same pressure. Headlines talk in national averages because they're easy to explain. Real outcomes happen locally. When rates rise, some areas freeze, some slowly decline, some barely move, some quietly offer the best deals in years. Assuming everything crashes at once is how people weight themselves into inaction. High rates actually hurt. High rates don't hurt everyone equally. They target specific groups. They hurt first-time buyers with low cash, sellers who bought recently with small down payments, investors who relied on cheap debt, anyone who needs to move quickly. They don't hurt long-term owners with equity, cash-heavy buyers, people who don't need to sell, investors with conservative numbers. This is why prices don't collapse across the board. The pressure isn't universal, it's concentrated. Fractures show up before crashes, before prices fall hard. Other things happen first. Homes sit longer, price cuts, increase seller concessions, grow negotiations, shift. These are early cracks. Most people ignore them because they're waiting for a dramatic drop. By the time that happens, the best opportunities are often gone. Investors watch for stress, not headlines. Affordability breaks before prices do. Rates attack affordability faster than they affect prices. Monthly payments rise immediately. Prices adjust slowly. That gap is where frustration builds. Buyers can't qualify, sellers resist cutting prices, transactions drop, volume falls long before prices do. That drop in volume is the signal. It means pressure is building, and something eventually has to give. Why some markets hold while others slip. Markets with strong job growth, limited housing supply, high income buyers tend to hold better. Markets that rely on speculation, investor demand, rapid appreciation crack faster. This is why blanket predictions fail. One city can drop while another stays flat just a few hours away. The 1% studies micro markets, not national narratives. Stress creates negotiability, even when prices don't collapse. Terms improve. Sellers start offering price reductions, closing cost credits, rate buy downs, flexible timelines. These things don't show up in headlines, but they change deals dramatically. A 5-10% price cut combined with concessions can completely reshape returns. This is where patient buyers win. The mistake of waiting for the bottom. Most people say they'll buy when prices bottom. The problem is you only know the bottom in hindsight. By then, competition returns, deals disappear, terms tighten. Smart buyers don't time bottoms. They buy when numbers work and stress is visible. High rates reward realism. This market punishes optimism. Deals that rely on appreciation, refinancing soon, rent growth assumptions get crushed. Deals that rely on cash flow today, conservative assumptions, strong margins survive. That's the fracture. Weak strategies break. Why this moment favors preparation. You don't need prices to crash. You need sellers under pressure, fewer competing buyers, time on your side. High rates create all three, but only for those ready to move. Final reality check. High rates don't end housing markets. They expose weak spots. They separate speculation from ownership, emotion from discipline, hope from math. Housing doesn't collapse evenly. It fractures quietly. And if you understand where and how those fractures form, you stop fearing high rates and start navigating them intelligently. If there's one thing this housing market is brutally clear about, it's this: speculation is getting punished. Discipline is getting rewarded. For years, housing was forgiving. You could overpay, stretch your budget, ignore cash flow, and still win because prices kept going up. Appreciation covered mistakes. Low rates masked bad decisions. Time bailed people out. That market is gone, and a lot of people are still playing by the old rules. What speculation actually looks like, and why it fails now. Speculation sounds smart when things are rising. In reality, it's just hope dressed up as confidence. Speculation looks like rates will come down soon, or rents always go up. I'll refinance later. Prices won't drop here. A worst case, I'll sell. Those assumptions worked when money was cheap and demand was endless. In a high rate, uncertain market, they're dangerous. Because now, every one of those assumptions can be wrong at the same time. This is where people get trapped. Discipline starts with numbers, not opinions. A disciplined market doesn't care how you feel about a property. It cares about math. Can the deal survive? Higher for longer rates? Flat rents. Unexpected repairs? Longer vacancy? No appreciation? If the answer is no, it's not a deal. It's a gamble. The 1% doesn't guess their way through uncertainty. They underwrite conservatively, assume things go wrong, and make sure the deal still works if they do. That's discipline. Cash flow matters again. For a long time, cash flow was optional. Appreciation was the real game. Now, cash flow is survival. Negative or break-even deals with the hope of future gains are exactly what high rates expose. Monthly losses compound stress. Stress leads to forced decisions. Forced decisions destroy wealth. In this market, a property has to stand on its own. If it can't support itself, it owns you, not the other way around. Leverage is no longer free. Low rates made leverage feel harmless. Borrow more, scale faster, worry later. That illusion is over. Debt is expensive now, and expensive debt demands respect. Discipline means lower leverage, stronger reserves, more margin for error. The 1% isn't afraid of leverage, but they treat it like fire, useful when controlled, destructive when careless. Speculators treat leverage like fuel. Disciplined investors treat it like risk. Reserves are not optional anymore. Here's a hard truth. Many people didn't lose money because their deals were bad. They lost money because they ran out of cash. This market punishes thin reserves. Unexpected repairs, vacancies, insurance hikes, tax increases. These things don't make headlines, but they crush overextended buyers. Discipline means assuming you'll need more cash than you think, because you will. This market exposes false confidence. Speculative confidence sounds like, I've done this before. I know my market. It'll be fine. Discipline sounds like, let's stress test this. But what if I'm wrong? Can I survive the test? Survive the downside? Intelligence, intelligence. This market doesn't reward ego. It rewards caution. Fewer deals, better deals. One of the hardest adjustments people have to make right now is accepting that you shouldn't be buying often. Speculation needs constant action. A discipline is okay with waiting. The 1% would rather miss 10 deals than force one bad one. They understand that in a tight market, deal flow slows, standards rise, patience becomes an edge, doing nothing is often the smartest move. The market is teaching lessons again. Easy markets hide mistakes. Hard markets teach them. Right now, the housing market is teaching. Don't rely on appreciation. Don't ignore cash flow. Don't underestimate expenses. Don't assume rescue from rates or policy. People who learn these lessons get stronger. People who ignore them get removed. That's how markets reset. Why discipline creates confidence. Here's the upside. When your numbers are conservative and your reserves are strong, fear loses its grip. You don't panic over headlines. You don't rush decisions. You don't feel trapped. You're in control. That calm is a competitive advantage. Final reality, check: this market isn't broken. It's selective. It doesn't reward optimism. It doesn't reward speed. It doesn't reward noise. It rewards strong math, conservative assumptions. Patience, preparation, speculation thrives in easy times. Discipline wins in real ones. And right now, housing is very real. If there's a single truth in real estate or any market, really, it's this: emotions destroy wealth. It sounds simple, but most people get it completely wrong. When headlines scream a Trump declares war on housing or rates at 7%, market crashing, people panic. They freeze, they react. They scroll social media for guidance. They ask friends for opinions. They start comparing themselves to people who got rich quick last year. The problem isn't the news, it's the response to the news. Fear makes people predictable. Fear is predictable. Fear is predictable. And predictable behavior is profitable for those who are calm and prepared. Think about it. When rates spike or headlines create uncertainty, buyers hesitate to make offers. Sellers who need to move quickly give concessions. Prices stall or decline slightly in specific markets. Those reactions are patterns. They repeat every cycle. They aren't luck. They aren't chance. They're human behavior. Prepared investors anticipate these reactions instead of reacting emotionally to them. They have capital ready, they have reserves, and they have a plan. The emotional buyer? The emotional buyer. They wait, they panic, they lose deals, and by the time they act, prices have shifted, competition has returned, or opportunities are gone. Preparation outperforms prediction. Here's the key distinction: most people never internalize. Speculators try to predict the market. The 1% focuses on being ready for whatever the market throws at them. Prediction is a guess. Preparation is leverage. Preparation involves cash reserves, enough to survive downturns and take advantage of deals without stress. Conservative underwriting, numbers that work even if rates rise, rents drop, or repairs appear. Liquidity and flexibility, the ability to walk away from bad deals, act fast on good deals, or weather delays without panic. Knowledge, understanding local markets, pricing trends, and policy impacts. When you combine these, you gain a rare advantage: calm in chaos. Everyone else is running scared. You are moving with strategy. Emotional decisions lead to overpaying. Emotions don't just slow decisions, they lead to bad decisions. In a high-pressure market, emotional buyers overpay because they fear missing out, stretch budgets because they don't want to lose a property, ignore fundamentals because everyone else is buying you the results. Over-leveraged properties, tight margins, and forced sales, when reality is. Prepared buyers do the opposite. They let emotion filter out and they evaluate deals purely on numbers. Numbers don't lie. They don't panic. They don't buy headlines. They only tell you whether a property works. The advantage of patience is an underrated form. Wealth. When the market is uncertain, deals sit on the market longer, sellers adjust prices slowly. Competition is inconsistent. For emotional buyers, this feels like frustration. For prepared buyers, it feels like opportunity. Patience allows selecting the best deals instead of the first available, negotiating from strength, because you're not desperate waiting for stress to create discounts or concessions. In other words, wealth quietly shifts to those who are prepared, not those who react emotionally. Real examples of the principle: imagine two buyers during a high-rate period. Buyer panics after reading headlines. They want to get in before it's worse. They stretch their budget, compromise on inspections, and offer above-market terms. And a month later, interest rates rise and unexpected repairs appear. Buyer A is stressed, cash-strapped, and trapped. Buyer B stays calm. They keep cash ready, analyze each deal conservatively, and wait for properties where the numbers work without hope. Rates rise. Some sellers start offering concessions. Buyer B swoops in with patience, negotiates better terms, and secures a property with healthy cash flow. Who ends up wealthier? Not the one reacting emotionally, the one who prepared. The role of liquidity: prepared investors don't just have cash for the purchase. They also maintain liquidity for unexpected events. Vacancies, maintenance issues, interest rate adjustments, tax increases. Liquidity isn't glamorous. It's boring. But it's the difference between staying in the game and being forced out. Emotional buyers often tie up all their money in one property, assume rents will cover everything, and discover too late that emergencies happen. Prepared buyers expect them. Emotional resilience is leverage. Being prepared isn't just about money. It's about mindset. Markets test your emotions constantly. Fear, greed, impatience, and envy are natural. Prepared investors don't eliminate these emotions. They design systems that make their emotions irrelevant. Automated savings or investment plans, conservative underwriting assumptions, contingency cash reserves, strategic exit plans. These systems make it impossible for fear to force a bad decision. Wealth is quiet. The biggest lesson here is that wealth isn't flashy. It's not about the loudest headlines, the fastest deals, or who guessed right. It's about quiet, consistent preparation. While the market panics, deals go unnoticed by emotional buyers. Opportunities slip past the impatient. The prepared quietly acquire assets, negotiate favorable terms, and position themselves for long-term growth. This quiet advantage compounds over time, and it's the reason the same people come out ahead cycle after cycle. Final reality check: wealth doesn't favor the emotional. It favors the disciplined, patient, and prepared. Headlines will always scare people. Rates will fluctuate. Policies will change. Your reaction is the only thing you can control. Prepare. Analyze. Stay calm. Keep reserves. Wait for opportunity. Let emotion pass through, but don't let it control your decisions. Because in the end, wealth shifts to the prepared, not the emotional, and understanding that is how you survive and thrive in any housing market.